Alibaba stock, ticker BABA, is currently trading like a penny stock. It's compared to the Amazon of China, but let's discuss the bull case behind Alibaba today because there's some fantastic catalysts which I think can make this stock explode in 2023 and beyond. But before I get into today's video now, make sure to check out my Patreon. Link is in the description. This is where you guys can keep up with my portfolio moves and all the latest stocks I'm looking into. So make sure to check it out. Alibaba's stock price has been absolutely decimated, going from $307 in 2020 all the way now in 2023 at $96 a share. Ironically, this is almost back at its IPO price in 2014 at $93 a share, except the business has been performing massively over the last 10 years and revenues and profits have skyrocketed, yet the fundamentals and the share price are completely misaligned. So this is where we now need to talk about some of the tailwinds that can increase the catalysts for Alibaba's stock price to shoot back up. Now, a significant growth driver to Alibaba is always going to be that Chinese economy. With a population of over 1 billion people, the middle class in particular is growing rapidly. And as that middle class matures, we're only going to see greater purchasing power, and that only benefits Alibaba in a big way. Increasing that purchasing power will only drive their revenue and profitability greater. So we can see the growth in the middle class has been exponential, and we're only in that second innings, if that. Expected households of middle class individuals is to grow over 400 million plus in 2035, which is expected to be pretty much doubling what it's currently at. And this is a great tailwind to have as a growth driver. And with that $1 billion pool of people, that is only going to mature as time gets on. Moving over now, diversification in the scale of Alibaba is immense. Operating through verticals such as e-commerce, cloud, media, logistics, and finance, the risk of this company isn't contained to one single vertical. It encompasses all these different higher margin businesses that can help improve with its profitability. And then this translates into the ecosystem, which helps with the diversification. There's so many different elements to Alibaba's diversification points, and we can see this through all the different businesses they own. Now, to add, the ecosystem of Alibaba actually has advantages over its competitors, creating those high barriers to entry. And from a consumer point of view, it deters them from leaving due to all the different synergies and all the different platforms that they're going to be intertwined like a web, as we can see. Like Amazon's e-commerce, it's the center of absolutely everything. But in the case of Alibaba, they are actually even more dominant than Amazon, which is crazy to think about just how large Amazon is and the different types of intertwined webs that both Alibaba and Amazon have created. They've created this huge system for consumers that makes them want to stay in their platform and not look elsewhere to other competitors. Now, one of the largest reasons why Alibaba is compared to Amazon is because they have very similar business models, not just in terms of e-commerce, but also in the cloud platform itself. Alibaba has the third largest in the Asia Pacific when it comes to cloud. And in 2021, it was actually the highest with a 25% market share in Asia Pacific. And this opportunity to grow this out further only is going to increase as that middle class drives higher and more businesses are wanting to use that Ali Cloud platform, and they increase the technical platform behind it. And this will only put Alibaba's margins much higher in the future, making it a much more profitable company. Now, the next bull case is a spinning off of the 6 companies into new firms to drive that created value for Alibaba. Now, the current market cap of Alibaba is roughly $250 billion, but when you spin off businesses in a large enterprise, the ability to value the sum parts can become much more accurate. Now, because of the bear case around Alibaba and the immense power of it becoming a potential monopoly, with China's CCP, they are restricting this by putting fines and their influence on Alibaba's business. And this has led to the stock downfall, which is down over 80% over the last 2 years. However, the situation drastically changes as spinning off the companies helps reduce that political risk around monopolization of Alibaba. And it helps then comply with the Chinese regulators through that anti-monopoly regulations. And this can only be a big bull case for Alibaba. Now, the next bull case is buybacks. Aggressively buying buybacks provides massive amounts of shareholder value, driving that EPS up and giving us more piece of the pie. Currently, there is a $25 billion US buyback program in place, while Alibaba is also focusing nicely on that free cash flow generation as well. So looking at the shares outstanding over the last 3 years, the reduction in shares outstanding has reduced by around 10%. And for a company as large as Alibaba, now this is a seriously significant portion. And on top of that, this is also expected to continue into the years ongoing. So creating that increased value of buybacks, the business is able to buy back huge amounts of its shares, which only gives us a larger piece of that pie, as I mentioned. Onto the financials now. Alibaba's annual growth rate in terms of their revenue has been closer to 35% compounded annually, which is insane. They've gone from 35 million won to almost 900 million won as of 2023. Yet the stock price is back at 2014 prices, which is insane to think about, but we can see this company has huge growth behind it, and this is only going to continue with the other catalysts, and it's unlikely to be impacted because they have such a diverse ecosystem. Onto the balance sheet now, we can see that Alibaba is cash loaded. They have $76 billion worth of cash and short-term investments, which is the most liquid form of money. So having this allows them to pay off their debts very quickly because they have this available. Then when we take a look further down at their liabilities, we can see that their total debt is closer to 21 billion. So they can easily pay that off with no problems whatsoever. They've got great cash and liquidity in the bank to weather any difficult storms that may occur. So we can see that Alibaba financially is in a very strong position. They've got huge revenue growth and they're cash loaded on their balance sheet. They've got a fortress balance sheet, which is what you want any large business to have. But in terms of discussing our valuation, I've broken down a 3-point model with a base case, bull case, and worst case to understand where we can actually find some sort of intrinsic value for this company. Moving over to the valuation now, we can see my 3 cases laid out to generate that intrinsic value, which I was talking about. So we can see on the right here, we have the different growth rates. We have 10% for the next 5 years, 5% for the 5 to 10 years, and then we have my discount rate, which is equal to 20% on all 3 versions. For my base case, I have a 16 terminal multiple, which is what Alibaba will be expected to be at in 2034. And that spit out a $226 intrinsic value, which, considering the current stock price of Alibaba is $26, you can see the upside potential of this stock and just how undervalued it is. If we take a 50% margin of safety, that would only spit out around $113. And considering you have it at $96, we are still very early when it comes to working out the cash flow in terms of what Alibaba can do in 2034. Then moving over to my best case, we're now talking about higher growth rates where we consider a 15% in the next 5 years and then a 10% from 5 to 10 years. And you guys might be wondering why the growth rate tends to decrease from the next 5 years to the 5 to 10 year range. And that's because as the business gets larger, it gets much harder to grow. So you have to reduce that revenue growth compounded because it gets harder. Then I had the discount rate at 20% still, and then I had that terminal rate slightly higher at 18, considering that other factors can come into place where they are generating higher margin business, which can potentially mean a greater terminal multiple for the future. Now onto the worst case, we can see I've got them just growing 1% in the next 5 years, which is very unlikely, but you can just see how undervalued the stock is. And then from 5 to 10 years, I actually have this increasing to 4% because I'm expecting that the Chinese economy will drive that growth, and then also maybe some relaxed versions of the CCP could come in, which can just help with that growth as they want Alibaba to do well. I've got the terminal multiple much lower at 14, which would be very low considering the S&P standard is anywhere between 16 and 18 terminal multiple. So it still comes out with a present sum of $135. So we can see that the business is still very undervalued. And then taking the average of all the three versions, it comes up with a sum of $184. So this is including all the three cases and taking the probability of each and deciding whether or not to understand the intrinsic value of this company. So using this, it clearly shows that this company is undervalued and is a buy potential. But there are obviously other factors, including the bear case, which I'll be uploading in another video. Now, the summary of everything in terms of the bull case for Alibaba, because there's some significant bull cases, and when recapping on absolutely everything, they have huge amounts of catalysts which can explode the stock price higher. When we consider the massive tailwind of just the Chinese economy, when we consider the middle class and the maturity that can increase the revenue just over time by having that huge population mature much greater. It's going to be fantastic for Alibaba. And then you have a huge intertwined ecosystem, which is so complex, but it makes competition coming in very hard to steal market share. And because Alibaba understands that Chinese consumer so well, they're in such a great position to keep driving that revenue and increase that ecosystem, making it even harder for competition to steal any market share. To add, we got a great balance sheet with $76 billion in cash. And then they have that revenue growth, which considering they're now trading back at 2014 prices, we can see the value that can be created by Alibaba. Not only that, they are buying huge amounts of shares back, which gives us as shareholders great value for money. And we just need to sit and hold and wait for them to keep generating the cash flow, reduce that shares outstanding, and we will own more of the pie. And that will improve all the metrics such as EPS, which will be significant in beating numbers in the future years. Not only that, there are many other factors Alibaba has to consider with their Alibaba cloud platform, which is growing crazy and it's a much higher margin business. And with the 6 businesses that are spinning off, including Alibaba Cloud, we can see that there's going to be huge, much more tighter value estimated in terms of what these businesses are going to be worth as soon as they're actually split off. Then we look at the valuation now. As we just looked at, the valuation is showing the intrinsic value is much higher than what Alibaba is currently trading at. At $96 a share, we get a lot with this business. And considering all these tailwinds behind this company, there is some great value for the bull case for Alibaba. Now, obviously, we do need to consider the bear case, which I'll be speaking about in my next video. So make sure to stay tuned. But if you guys aren't already, make sure to drop a like in this video, subscribe if you haven't already, and follow my Patreon, link is in the description, to check out all my latest stock moves